In 2011, Germany made a decision that seemed morally right, politically popular, and economically harmless. 15 years later, that decision is quietly draining one of the world's strongest industrial economies, not through a sudden collapse, but through something far more dangerous, an invisible erosion that your portfolio hasn't priced in yet. If you hold European stocks, trade the euro, or have retirement exposure to German industry, what's happening right now will reshape your returns for the next decade, and most investors still don't see it coming. Here's what makes this story so dangerous. It's not about the decision itself. It's about how long the consequences stayed hidden. In 2011, Germany shut down its nuclear program. This wasn't framed as an economic sacrifice, but as a moral correction. Nuclear was risky, outdated, and politically toxic. The assumption was simple. Replace it with renewables, import what's needed during the transition, and let Europe's strongest industrial base absorb the cost. For a while, that assumption looked correct. Factories stayed open, exports grew, the euro remained stable. Germany appeared to prove that you could lead morally and dominate economically at the same time. But energy decisions don't hurt immediately. They create delayed pressure. They don't break systems. They weaken margins. And Germany's entire economic model runs on margins. Germany's economy is built on one fragile equation: cheap, reliable energy feeding high-value manufacturing exports. Cars, chemicals, machinery. These industries survive on predictable energy costs at massive scale. When Germany exited nuclear, it didn't replace stable power. It replaced it with complexity. Wind and solar expanded, but so did weather dependency. The electrical grid became exponentially more expensive to manage. Still, this didn't break anything, so Germany compensated. It imported massive quantities of cheap natural gas through pipelines, allowing the illusion to continue. The economy kept running, and the real cost stayed hidden in import bills and long-term contracts. By the late 2010s, Germany had locked itself into a structure where keeping the lights on depended on other countries staying friendly. Then, after 2022, the world changed. The cost structure snapped into view. Gas prices spiked. Industrial contracts written years earlier became liabilities overnight. What had been a manageable expense became a competitive disadvantage against manufacturers in America and Asia. This is where most analysis stops. Energy crisis, external shock. But that's not the real story. The real story is what happens next, and why 2026 matters for your portfolio. When energy costs rise, companies don't shut down immediately. They absorb losses, squeeze margins, and delay new projects. That's what Germany has been doing. Factories didn't collapse, they just paused growth. Production quietly shifted to plants in other countries. Germany didn't lose industry overnight, it lost future industry. Now we reach 2026. This is the year where delayed consequences collide with demographic reality. Germany is entering a demographic inversion. More retirees, fewer workers. This strains pension systems, which run on cash from productive businesses. And cash flow depends on companies making profits that can be taxed. Here's the chain reaction investors need to understand. Higher energy costs reduce company profits. Reduced profits mean lower corporate tax collection. Lower tax collection forces government borrowing or spending cuts, right as pension and healthcare costs are rising. Something has to absorb the shock. It's not corporations, because they can move. It's the domestic economy. This is why the system doesn't collapse. It slowly tightens like a vice. People ask, why is Germany struggling now? The correct question is, why didn't it struggle earlier? Because the costs were deferred. For investors, this creates huge risks. German industrial stocks are trading as if this is a temporary dip. But many of these companies face permanent margin compression. They're not going to recover their old profitability. At the same time, companies providing energy efficiency solutions and grid management technology are positioned to capture massive value as manufacturers desperately try to cut costs. By 2026, Germany finds itself in a position where reversing course is nearly impossible. The nuclear infrastructure has been dismantled, the specialized workforce is gone, political consensus has fractured. So instead, Germany does what stable democracies do under pressure. It redistributes the pain quietly, through regulatory fees, tax adjustments, and slower economic growth that compounds year after year. The decline isn't dramatic enough to trigger crisis selling, but it's real. This matters beyond Germany's borders. Germany anchors the European economy. When it slows, Europe drifts sideways. The dangerous part for investors isn't that Germany made a bad decision. It's that the consequences arrive after political accountability has expired. The economy, however, remembers every decision. This is how strong economic systems weaken, not through a crisis that forces change, but through choices that felt safe at the time, with hidden costs that only became visible after the decision was irreversible. Why is Germany, the industrial powerhouse of Europe, suddenly looking so fragile? It's not what you think. The real story isn't the 2022 gas price spike. That was just when the markets finally woke up. The real problem started over a decade ago, with a single policy decision that's now coming back to haunt its economy. German manufacturing doesn't think in quarters, it thinks in decades. When a company like BASF builds a chemical plant, it's a 30-year bet. When a car maker builds a new production line, they need 15 years of predictable costs. These are giant, rigid systems. They can't just pivot on a dime. And for years, a quiet killer has been eating away at their foundation, slowly rising energy costs. Think about it. Competitiveness in global manufacturing is a game of inches, or rather, fractions of a cent. A few percentage points on an energy bill, a slightly more expensive supply chain, these small margins compound. They decide if the next billion-dollar factory gets built in Germany, or gets redirected to Poland or the Czech Republic. Once that investment flow reverses, it's incredibly hard to get back. And that brings us to the critical year, 2026. The factories built around 2012, when energy costs still seem manageable, are now due for major reinvestment. Executives are asking themselves right now, do we double down on our German facilities, or do we move production somewhere cheaper? They're making this choice in a world where German energy is structurally more expensive and policy is uncertain. The old advantage has eroded. What makes this so tricky for investors is that Germany's political system is built on consensus. That's usually a good thing, but not when you have to admit you made a trillion-dollar mistake. No politician wants to say the nuclear phase-out, framed as a moral imperative, had massive hidden costs. So the pain gets disguised. High electricity prices are blamed on Russia. Industrial decline is blamed on China. But these are just symptoms. The root cause is an energy cost structure that no one in power wants to admit was a policy failure. For decades, Germany's premium stock valuations were built on one thing: industrial excellence. That excellence was built on cheap, abundant energy that everyone took for granted. Now, German executives spend their time worrying about energy hedging instead of product innovation. Capital that should go to next-gen manufacturing is being diverted to just manage energy costs. It's a slow, subtle shift, but after 15 years, it has created a fundamentally less competitive industrial base. Add to this a demographic time bomb. Germany's workforce is shrinking. To maintain output, you need huge productivity gains, which require investment. But who invests when the future looks so costly? At the same time, a smaller workforce has to support more retirees, which means taxes need to go up. Higher taxes make the cost problem even worse for companies. It's a vicious cycle. So what are companies doing? They're managing the decline. They keep factories running and pay dividends to keep shareholders happy, all while quietly shifting new growth investment to other countries. The surface looks stable, but the foundations are cracking. For investors, this changes everything. German industrial stocks with high energy use face permanent margin pressure. The euro itself is under long-term threat. But there's opportunity here too. Companies providing energy efficiency and automation are set to boom. And this isn't just a German story. It is a warning for any country that makes irreversible decisions based on short-term politics instead of long-term economics. The biggest risks in your portfolio aren't the sudden crashes. They're the slow grinding pressures that everyone ignores until it's too late. Germany is simply the first to feel the full force of these delayed consequences. The question is, which country is next? If this deep dive helped you see the invisible forces moving markets, hit that subscribe button. We break down the structural shifts that determine who wins and who loses over the next decade. Let me know in the comments what other major policy shifts you want analyzed. Thanks for watching.